Bloomberg Audio Studios. Podcasts, radio, news. This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Masser and Tim Stenevec on Bloomberg Radio.
Let's get to Peter Tchir. He's head of macro strategy at Academy Securities. He's back with us in our Bloomberg Interactive Brokers studio. It is kind of wild, Peter, considering how this year has started and the actions in Venezuela, and then kind of markets to look past it. I'm just curious your view on this, and I'm curious what kind of calls you were getting from either clients at your firm.
So we certainly had a lot of questions about Venezuela over the weekend and into this week. It's at Academy we work with 30 retired generals and admirals, so we've been doing.
We had one on yesterday.
That's right, yeah, Master Robinson, he's great. I think the market moves actually do make sense, though. I think this is start of the year stuff. You got CES going on, so there's a lot of headlines coming out of Vegas that people seem to like. So I'm not surprised that we're kind of rallying. Away from that, I think on Venezuela, it was a very impressive military operation. Whatever else you want to think about it, it was very successful, incredibly fast. This very precision. Now I think we're not going to see a lot on oil, energy prices. I think there's a lot of building out. And what I think this is going to really
None of this is a quick fix.
None of this is a quick fix. And I think what this is really going to boil down to is this is our first real confrontation with China away from either's kind of sphere of influence, right? If you think about all the trade negotiations, it was mainland China versus us. There were some tariffs, but all of a sudden we're going and saying we're going to take stuff. Yeah. China's invested a lot of money there. China has a lot of loans to companies. How is that friction going to play out? China's going to use their lawyers to try and stop things. I think this is really important too for China, because if they kind of get pushed out of Venezuela very easily and they lose money, the rest of the world where they put out their Belt and Road Initiative starts looking at that, and it could be a big roll-on effect. So I think we're going to see friction. I honestly think we're going to see China first attack with lawyers, and they won't attack anything until they start seeing what we're actually doing. So far, it's just been a lot of talk and noise.
Right.
Venezuela was the story yesterday, and it certainly is today. But in the last few minutes, Greenland has become more of a story. President Trump and his team are discussing a range of options for acquiring Greenland, a Reuters reporter says in a post on X, citing a White House statement. Where does that strategy fit in?
That one's a hard one for us. I think when we look at the world, when we kind of Iran, we could see maybe doing something to the IRGC. I don't think we would do anything with the religious side of Iran in any way, shape, or form.
When you say do something, what do you mean?
Maybe we would support, to attack some of the IRGC facilities or something. Okay. If the IRGC gets very aggressive against the protesters, I could see something going on there. Cuba seems a little bit more easier to deal with. We already have the, USS Ford is in the Caribbean Sea. It's actually not a very efficient place for it to be. It's too small of an area for an aircraft carrier group, and it's due for some refitting and remodeling. So I think we will try and use it as much as possible. So that's why we weren't surprised about action in Venezuela. I think we could see activity in and around Panama Canal where we try and either buy it or invest in it.
Is that for a China proxy?
I think for a China proxy. And again, I think we really want to control shipping through Central South America, and the Panama Canal is a big part of that. And don't forget, Marco Rubio is the first place he went. On Greenland, I think we all struggle with why this term annex or take keeps coming up. I think that's a struggle. So
to recap, Panama, Venezuela, Cuba, Iran makes sense. Greenland, not so much.
I find it very difficult to play why we would disrupt NATO. And again, I think we've been less thoughtful on NATO and where its important is, but this kind of puts a lot of friction. And even from a business standpoint, I think I can believe that in Venezuela, there's a lot of rare earths and critical minerals that have been underinvested in. I find it hard to believe someone hasn't been checking out Greenland and saying, this is just economically unviable. I do know, and I think this is interesting, because one of our generals is actually now the Undersecretary of War, and before he became Undersecretary of War, while he was still working with us, he did talk about and point out that China has more icebreakers than we do. And so China views themselves as an Arctic nation. Russia clearly views themselves as an Arctic nation. So maybe this is something to do with, as the polar ice caps are melting, that it creates different routes. So we want some more protection there. So maybe some of that makes sense. But again, that all feels like it could be done within the confines of existing rules and regulations rather than having kind of this annex or take concept.
Yeah, I mean, I don't know. How are you thinking about this year when it comes to the Trump White House, and especially with midterms looming? I've heard some folks say that, listen, there's a lot of pressure on the administration to get things done early in the year because as midterms loom, there are expectations that there might be pushback pushback against the GOP and the Trump administration. But I'm just curious what you're telling your clients.
So what we've really liked is what we've been calling PROSEC, or production for security.
Right.
And it's kind of along the lines of resilience. And that includes anything from chips, electricity. So Intel, for example, I think there's going to be huge pressure on companies to use U.S. chip manufacturers, right? We have to break away from Taiwan. I think there's realization we're not producing enough electricity. We will deregulate, we'll get electricity in all forms running. I do think President Trump will give up on his kind of hatred of solar and adapt solar, but you're going to see solar, nuclear. I do. I think it's just
wind is a step too far.
I think wind's a step too far.
I think he really does not like wind.
He really does not like. I think there's a visceral hatred to it. Partly, I think it does destroy views. I think there's questions about its efficiencies, and it does kill birds and stuff, and that seems to really bother him. So I'm not going to fight the wind. I do think on solar.
House cats kill a lot of birds too.
House cats.
Truly.
That is probably true. We had one that was very good at that.
True.
So I think those are all the things that we can invest in. We just saw yesterday $2.7 billion going into uranium companies. So I think you can move away from the AI story and into anything that's going to be part of this building out of infrastructure. You know, you've got CAT, you've got Deere, Navistar, all the heavy equipment makers. I think we're going to see real efforts to become slightly more independent.
Are all nations doing that?
So how I see this starting is the U.S. really jump-started this, right? The U.S. has been all over this. I think what we're starting to see now is capital is going to follow next. So investors are starting to follow this. We talk to private equity companies who are starting to scour the universe for, hey, who's got mining rights that have been unused? Who's got some interesting patents in and around these rare earths and critical minerals? I think you're going to see, again, these huge build-outs potentially in electricity production. So it's capitalism.
Globalization dead?
Well, I think other countries are going to figure this out eventually that they have to do it. I think at some point, Europe's going to release like Shell and BP to actually do what they're phenomenally good at. And so far, there's still constraints. But I think everyone's adopting this. I think you have to look much closer when you're thinking about supply chains. Domestic
political risk of this new world order. That's something I've been thinking a lot about, especially in an election year, because we thought that the Make America Great Again movement was really about keeping within the U.S.'s borders, not getting involved in foreign wars. The president has talked about leaving countries outside of the U.S. alone, and that's not really what we've gotten in the last few months.
No, though I will say, I think if prior to Liberation Day and stuff, I think there was a lot of hope that we'd work very closely with Canada, because Canada has a lot of things that we need that would be a big part of this. We'd work closer with Mexico, and we kind of got away from that. So I think this starts, maybe it's just trying to reshape how these relationships work. Ultimately, I think we're going to need things like potash. We're going to need to work with Canada. But I do think, they laid it out in the National Security Strategy, and it's only 39 pages of double space. It's even I could read it. So I would recommend reading it because I think it does form this way. And we've been telling corporations for years now, and I think now we're getting a lot of incoming calls. Like we've been saying, if you are manufacturing in Thailand and Vietnam, you're not really diversified because you're going through the same shipping lanes. So I think you've got to be very careful about shipping. If you're looking at building a new plant this year, I think you want to build it in North, South America or Central America or the US, precisely because that's where we have a lot more control. So I think that's where corporations follow into this. And I don't want to say it's going to be us by ourselves. What I've been trying to say is I think for every single commodity or product, every country is going to have an X amount that they want to do themselves so they can be sufficient. Y you can do with your close neighbors, and then Z or Z you just do on the open market. And I think that's going to vary by country to country what they can do. But I think Europe's behind on this. I think the sad thing is, if I look at what we need to do in the US, you have a pretty good roadmap. Just look what China's done for the last 10 years, right? They've basically done PROSEC on steroids, and we're just starting to do it, but it's exciting. And I think some of it will last past an election cycle, because Biden did do the CHIPS Act, right? So Biden was not, immune to understanding
he continued
this.
a lot of President Trump in his first term, his China strategy.
Right. So I think this is now truly going to replace ESG as a major policy tool, as a major way corporations think, and how investors think, right? If everything was ESG, I think where we were really is, if you think about Maslow's hierarchy of needs, one probably, Psych 101, it proves I took it, but we were kind of at this kind of high self-actualization period, like what would we like sustainability to look like? But it was all based on the premise that we had the basics covered. Well, we don't really have the basics covered if we're dependent on China for those basics. So I think this is a pullback to say, to be truly sustainable and independent and resilient, you need to do some core level of this stuff yourself. And that's where I think we are. It's that evolution.
What are the implications of that in terms of cost to society in terms of, does it make things more expensive? If we're doing more manufacturing in the United States, well, labor isn't cheap here. So I'm just curious, what are the implications? What does it mean for economic growth maybe in the United States?
So I think it's going to be potentially a little bit higher on some prices. So it's very good that oil and some of these energy costs are coming down. That will help on this. At the flip side of that, though, is if people can go back to working for, I hate to say the word, but I'll say it, like national champions, right? Where you feel that your industry, your job is important to the country, you probably go home feeling slightly safer about your job. I think there's a lot of benefits from this. We've been talking about the Spider Marks is great. He kind of coined the phrase for us.
Yeah.
But
who is?
Spider Marks, General Spider Marks. He's quite awesome. But he coined the phrase like we're in a pre-war environment. And we've always been in a post-war environment until recently. And I think pre-war sounds a little bit scary, but it's just like deterrence. If you understand that you're in a pre-war and you do the preparation properly, you deter the enemy. And I think the things that to me are really crucial about a pre-war is it creates a sense of urgency, which we're seeing, and self-sacrifice.
We're speaking with Peter Tchir, head of macro strategy at Academy Securities. He joins us here in the Bloomberg Interactive Brokers studio. Peter, you mentioned we went through a little bit around the globe when we talked about Iran, we talked about Venezuela, we talked about Greenland, Cuba, Panama. What about Mexico? And what about Colombia? Have they been put on notice?
I think Colombia's been put on notice. I've been much more focused on Mexico. So one of the things that we believe to some degree is we've been changing the rules of engagement with Venezuela, right? If you go back 4 months ago, who would have thought we would shoot a drug boat? We're now doing that. I think the world would have gone ballistic if we did that in the Gulf of Mexico or Gulf of America. Now, though, it's now standard operating procedure, right? We've attacked some of the drug facilities. I suspect that somewhere in Q1, Q2, late Q1, early Q2, we approach Mexico very serious and tell Sheinbaum, like, we can work with you to get rid of your cartels, or we can get rid of your cartels without you. And to me, the one thing we haven't talked, I know we've been talking about so much oil. If we can solve Venezuela's drug problem and cartel problem and Mexico, it makes both of those countries safer, more viable countries. Fewer people need to migrate out of those countries. That's what I was just going to say. Yeah. So I think it fits perfectly.
But then in terms of drugs, maybe I'm crazy here, and I know we've only got about 40 seconds left here. What about China and fentanyl? Like, have we covered that? If we're talking about narco-terrorists,
I think
some might say, wait a minute.
I'm looking at this more from the ability to kind of make those countries safer, where you have some ability to influence it so that people don't want to leave. A lot of people, you talk to people coming from Mexico, their choice is lead or silver.
Yeah.
You either fight the cartel and die, or you join the cartels.
Look at Venezuela, 8 million people or something have left.
So I think if you can do that, and on top of that, if you cut the head off the snake, maybe the drug cartels and their activities in the U.S. do slow down.
So you're positive about the year? Are you upbeat?
I am, actually. I'm very positive. I think, again, this build-out's going to be very interesting.
Yeah.
The biggest risk to me is China threatening and doing something about rare earths and critical minerals, because we're not there yet where we need to be.
10 seconds. If President Trump wasn't in the White House again for a second term, would we be having this conversation?
No, I think he actually really kind of planned ahead of this. Though some of it, I think we would have finally seen, because we've been talking about rare earths, critical minerals for years and years. We're finally realizing the CHIPS Act realized some of this. This is a progression.
Too.
How we're doing it is just stronger and more aggressive.
Such a great conversation. Peter Tchir over at Macro Strategy and Academy Securities.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Bloomberg spoke with economists, U.S. politicians, and heads of trading firms and hedge funds to understand really what's at stake in the prediction markets boom. Denitsa, Tsekova, and Lydia Beyoud are part of the team behind the story. Denitsa is Bloomberg News cross-asset reporter. Lydia is Bloomberg News financial regulations reporter. Denitsa here in our Bloomberg Interactive Broker studio. Lydia joins us from Bloomberg's Washington, D.C. bureau. Lydia, I want to start with you in Washington because you cover financial regulations. Prediction markets, is it fair to call it gambling?
I think these days people increasingly are seeing a blurred line there. To your point about marketing speak, the companies are very keen to describe themselves one way, but certainly within Washington, I don't think a lot of people are seeing much of a difference. And for sure, in the sports gaming world, they see them as direct competitors.
Yeah, it's interesting. Gaming, gambling, what exactly is this? Denitsa, come on in. For those who maybe have been, living under a rock, which is kind of fine. I like to kind of hibernate every once in a while. Remind us what these prediction markets are all about and who are the big players.
Yeah, 2025 was the year of prediction markets. We had two big firms kind of dominate the space. Of course, Kalshi and Polymarket. Their valuation went through the roof. They started from like 1-2 billions and both ended the year in the double digits of billions. So really, really rapid growth. And we're seeing not only those tech Silicon Valley names, we're seeing a lot of traditional finance names. We're seeing CME. We're seeing a lot of those traditional finance players getting involved in the space. So clearly, this is an interest more beyond Silicon Valley. The volumes are crazy.
But tell us how it works. Like, can Tim or can we go out and place a bet? Like, who determines who can do what on the platform?
Super simple, super easy. So obviously sports betting you have to be 21. For this, 18 is enough. It's very accessible. You go, the bet is like as cheap as like a few cents or $1. And
you just go and create it on
anything. It's very simple. Yeah,
you can create the bet.
No, you cannot create a bet. You can place a bet.
That's what I'm asking.
Yeah, there is a way to claim a market, but of course it's up to the platform to create. But as we have seen in recent months, there is a lot of variety of bets on things that anywhere else you cannot bet, from the bet on Nicolas Maduro being outed to any type of pop culture thing and any type of
top artist on Spotify this year is on Kalshi right now.
Of course, that's very popular. Any type of mention market. People are watching like politicians talk on TV and betting on every word they say, every twist. And, like, people are even making fun of this. We famously had the Coinbase CEO knowing that people are watching what he says on the earning calls, so he was crashing the market.
So that's where I want to bring in Lydia, because when you're in a world, Lydia Beyoud, where there is one person in control, like a CEO of a company, like Elon Musk, if the number of tweets that he sends between a certain period of time, that's a bet on Polymarket right now, or a prediction on Polymarket that one can make. What is the slippery slope that opens when one person is in control of the outcome here?
So that's something that I think regulators and policymakers are really grappling with. Particularly, I think the Maduro example that we highlight in the story has really made that so salient for everyone. Right now, generally, federal rules prohibit federal employees from trading on non-public information for their own financial gain. I think Representative Richie Torres is planning to introduce legislation, if he hasn't already this week, that would very clearly prohibit that type of trading on prediction markets. But really, we're kind of facing a different regime compared to how I think a lot of people think about insider trading that is regulated in equities markets or markets overseen by the Securities and Exchange Commission. Because, if you're in the derivative space and you are an energy producer, an agriculture producer, you're expected to trade on knowing, my crop's really great this year, or we're pumping so much oil and gas out of the ground. I'm able to hedge my position and sort of let my knowledge that I have inform both me and then the market. There's kind of a market utility argument that is made in those traditional markets, and we're seeing that, again, sort of these blurred lines shift into prediction markets, and people sort of grappling okay, well, what's okay insider information? What benefits everyone to have insiders trading and kind of, as they like to say, drawing on the wisdom of the crowd and doing price improvement. But
so not exactly truth machines, right?
Well, that is the big debate about how are you going to draw that line about, if you are Elon Musk there are mention markets and what you might say during your, not to pick on any executive.
Right.
And you're going to, there are mention markets on what you might say in your quarterly call. Do you swing a market just for funsies? Do you swing it knowing that, your buddy's buddy might have some money riding on the line? And then how does anyone catch that? Should they be catching it? There's so many open policy questions that are being asked, I think, around Washington right now because of these markets.
Yeah, there's an interesting, I'm just going through Kalshi. You could spend, I know both of you did this, you can spend hours going through this, but does it really serve the market, Denitsa, to ask if will Taylor Swift and Travis Kelce be married before January 1st,
That's
2027?
important stuff, Tim.
It is important stuff. We had a lot of Bloomberg headlines on this as well. But indeed,
did we?
We did.
Okay, I didn't know.
But it is important. So what a lot of those prediction micro believers says, we're going to bring a lot of people through sports. So for example, Kalshi has 90% of of their volumes very often coming from sports. So it's pretty hard to make the argument that this is a truth machine at the moment. But what some people hope and believe is that eventually some of those casino elements, some of those betting elements will bring people who want to bet on things like economic data, things like maybe people want to hedge. Like the hedging scenario is something that has come up a lot. Talking to people, it seems like it's not coming anytime soon, but people are saying, oh, maybe I want to hedge the weather in Florida. Maybe I have a house and I can buy insurance.
Well, I don't understand that.
They keep going on topic, and I'm trying to take them off topic. Like, here's another one, for example. What will Rachel Maddow say during Jimmy Kimmel Live?
Right.
Okay.
That's a classic mention market.
Epstein, corrupt/corruption, ICE, Russia, Ukraine, affordability, healthcare.
All right, but there's serious stuff like the Fed decision in January. 89% say the Fed will
actually helpful for what we do.
And we talked
sure.
about this
Fed
during
chair.
elections and different things.
For sure. Elections have proven to be one pretty good
Help
market
me understand, though, and, well, Lydia, come on back in here. One of the things I'm curious about is, like, who is checking, who is making these trades? Is Kalshi or is Polymarket, are they actually checking, especially when it could be potentially insider trading? Do they know exactly who's making these trades? Are they doing due diligence?
So these exchanges are structured as self-regulatory organizations, so they're supposed to kind of monitor trades and root out any potential for market manipulation. Again, the sort of where you draw the line between what's okay and what's not okay on insider trading, that's a judgment call, I think, except in all but the most clear-cut instances. But exchanges can self-report information to the CFTC. The CFTC can look into it. Again, it operates differently than the Securities Exchange Commission. But
what's the bandwidth for regulators to want to take this on?
The CFTC is chronically underfunded. They have, I think, roughly 500 staff. The SEC has four or five times, maybe 10 times that number, not quite, but they are understaffed for the task at hand, and there are more applicants. I mean, I think we mentioned in the story that there's a lot of interest driven heavily by sports trading, but also in the economics, also in other spaces. And so they're kind of underwater in terms of all that there is to do for market demand for this space. So I think a lot of people are wondering what the CFTC will do, but if we look at the new chairman, Michael Selig, when he was an attorney in private practice, he wrote a comment letter that was pushing back during the Biden administration on any effort to rein in sports prediction markets, for example, or really most prediction markets. So I think you've got someone who's very, he said he's going to defer to the courts on how the courts might eventually rule on this topic, but at least when he was an attorney representing clients, he was very much in favor of them.
Before we let you guys go, Denitsa, if we think about the universe of prediction markets, Robinhood's getting into it. Kalshi and Polymarket are the big ones, and they count, I think, a Trump as advisors to both of those.
Yeah.
Are these all regulated the same way? Or is one regulated differently than the others?
So also, obviously, they have the Trump as advisor, and Trump Media is looking into launching a prediction
Great
market.
point.
And a lot of the sports betting companies are looking to also get into prediction market. Kalshi so far is obviously under the CFTC. Polymarket is just entering the US. They have this beta test, so they're only onboarding some users. So currently, most of the bets on Polymarket are actually in this weird regulatory space where a lot of them are coming from abroad and isn't necessarily regulated. Under the CFTC, we've seen very different decisions. For example, there was a market connected with the United Care CEO killing, and CFTC asked Kalshi to remove that market, but Polymarket, who is not under that jurisdiction, actually kept the market. So you can see there are very different outcomes depending on the regulation.
Will a human land on Mars before California starts a high-speed rail? 19% chance. Costs 20 cents for yes, 85 cents for no.
Well, what counts as the high-speed rail?
I don't know.
Is it just like...
I'm just reading here.
Okay.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
David Royal is Chief Financial and Investment Officer over at Thrivent. The firm has close to $200 billion in AUM, probably more as of now. That's a number from a little over a year ago, David. What did you think of what we heard from Mike McGlone just now? I mean, is this what happens in a late stage bull market?
Yeah, I think so, and I was amused. Absolutely. I've never gotten more questions about gold and silver from clients, and I regularly meet with clients and our advisors. I think it's fears of currency debasement. So the retail clients are really interested in metals right now. And the question I always ask in response when I get a question about gold is, what problem are you trying to solve with gold or silver? If you're worried about currency debasement, you could have a diversified portfolio of commodity stocks. There are probably better ways to deal with inflation or currency risk than just owning gold or silver. But silver is behaving like high beta gold right now. I mean, and it does feel very technical.
That currency debasement, the dollar mostly, or current?
I think it's both.
Currencies.
I mean, we had dollar weakness early in the year. Dollar strengthened later in the year. I think it's general concerns about the deficit and the federal budget.
That's so interesting. I mean, I go back to this idea of you hearing from clients more about metals than ever before. Is that indicative of something within the markets right now? I mean, you mentioned the currency debasement is a concern of theirs, but is there something else happening too? You think like this is sort of a YOLO buy everything rally,
or beyond the concerns about the
deficit? I think it's less YOLO and more. It's a very bifurcated economy. A lot of concerns, political turmoil. People are just very concerned right now. Consumer confidence is very weak, despite the economy being pretty strong. And
yet, I've got to tell you, how many people have come around this table and said, "Well, wait a minute. The stock market's hitting records." The wealthier consumer, which is so important in terms of consumer spending, doing just fine. I agree with you. That lower rung of the K-shape, I'm concerned. Tim's concerned. You sound concerned. I mean, we all should be concerned, right? Because that's a big part of certainly America. So I just do wonder, and I wonder when people care more broadly, and when it does really matter in terms of the overall economic health of this country.
Yeah, I certainly get a lot more questions about metals than crypto these days. And I would say it was the reverse maybe 12 months ago. There's a lot less interest in crypto, probably because Bitcoin's been weaker recently, and it seems to have shifted. But I think there's just sort of a generalized concern, and that's, again, why I say, what problem are you trying to solve? I mean, metals, and even crypto, have probably a place in a diversified portfolio. But again, what role does that have in your overall portfolio?
Talk about the interest or lack thereof that you're seeing in crypto right now. I mean, do you actually, at Thrivent, is it a part of a recommendation that you have for clients' portfolios?
We don't broadly. I mean, they have access to it through brokerage.
Yeah.
I mean, clients could buy crypto ETFs.
Are they doing that?
And I'm sure some do. It's not part of our centrally managed portfolios that I oversee.
What more so is, like, more traditional?
More traditional stock.
If somebody wants alternative exposure, what are the alternatives that you recommend?
So we, would look at potentially metals, REITs, and things like that. Within our mixed asset products, our asset allocation funds, we actually have an allocation to private equity within our daily liquidity mutual funds. It's a small allocation, but we actually do give retail clients $50 a month. You can get access to private equity at Thrivent. That's a pretty cool thing.
Where are flows going at this point? Where are investors either asking you to commit, or where are you guys recommending? Where's money going into, money coming out?
We're seeing strong flows into our managed accounts. There's still a lot of interest in equities. Overall, across the industry, you're seeing strong fixed income flows, as we have in recent years.
Continuing to see that,
yeah.
Right, because it was an interesting year in where you saw both stocks and bonds do well, right? Which is not typical, and always makes me a little nervous and cautious.
One other observation on flows is, across the industry, money market assets have, roughly doubled from $4 trillion 4 years ago to $8 trillion. Our own money market fund has quadrupled over the last 3 years.
But rates are coming down.
The rates are coming down. So
where does that money go?
I keep telling clients, you got to be extending duration right now. Lock in these attractive yields.
Well, okay, so where's the right place for a client to put money that's been in a money market? They want access to it, but they also want yield that's higher than 4%. Yeah. Where can they go?
What I've been recommending lately in taxable accounts is munis.
I knew you were going to say that.
Of course. You threw me that. No, I love munis right now. They're not quite as attractively priced.
But what's the right way for an investor, like a retail investor, to buy munis, especially if they live in a high tax state?
I'd buy an actively managed municipal bond fund. And because, you do need, I think, active management in that space. We offer we have a core muni bond fund and we have a high yield muni fund. So I often recommend clients split their assets between a regular muni and a high yield muni fund.
How high yield are we talking about?
You can get about 4.5.
Okay.
Which on a tax
And
equivalent
tax-free,
basis is
yeah.
in tax free and about 4, a little less than 4.
Okay.
That's very attractive because if you look at corporate bonds, you're going to get about 5-ish%, a
But you're
little
paying taxes on
5.5,
that.
and you're paying taxes on that. So to get a similar tax equivalent yield of 7.5, you'd be well into the high yield space.
But this is what happens, Carol, in a rate environment where rates are coming down.
Yeah, exactly. We'll see whether it continues. I mean, what are your expectations in terms of rates and how that impacts kind of the investment environment?
So
and
I
opportunities?
think it's going to be interesting this year. We're pricing in, I think it was last I looked, of course, on my Bloomberg terminal, about a 16% chance of a January rate cut. The market's not expecting that, but we are seeing some pretty significant employment weakness. And January's probably off the table, but I wouldn't be surprised if we see a couple cuts in the first half of the year. Of course, we're going to have a new Fed chair announced fairly soon, so that May meeting is starting to look like we'll get a cut. But I think the average rolling 3-month jobs added was 20,000, and even if you back out the 100,000 or so government jobs that were lost, it's only 50,000 over the last 3 months. Powell in 2024 at Jackson Hole said any further weakening in the labor market would be unwelcome, and they were averaging 120,000 a month back then, and actually 170 before revisions based on the information he had.
But do we have to look at that comment in the context of a low or no illegal immigration world? Like, do we have to completely reset what a healthy number looks like in an environment where immigration has to stop?
The reason I think we're seeing some increased weakness is really other indicators. So over the last 3 months, we've had 900,000 people move to part-time employment for economic reasons. They would like a full-time job. That's gone from about 4.5 million to almost 5.5 million in the last 3 months. That's the sign of a weakening labor market. And wage growth last month was almost zero.
So what does that look like for that group of individuals you talked about? Is that people who want a full-time job, but maybe they're doing gig work instead?
Yeah.
This is what Danielle DiMartino Booth talks to us about.
Yeah.
She's concerned about the weakness. She's talked about this over the summer.
I'm not listening because I've been thinking about the stocks.
Oh.
That
I'm sorry.
No, I'm really sorry.
I'm so sorry to interrupt you, Carol. What were you thinking about?
Well, I was looking at the notes, and David, the stocks that you like, Shark Ninja, Build-A-Bear. I mean, these are not names we talk about.
Carol talks a lot about Build-A-Bear.
So I'll give you Boot Barn's in there too. We love Boot Barn. I don't know if that was on my list. So I'll give you the theme that we like within consumer. I know we focus a lot on the consumer.
I do listen to most things you guys say.
They're fun names.
Tim says. But anyway, yeah.
So the theme is we talk a little bit about the K-shaped economy. The upper end consumer is doing better than the lower end consumer.
Yeah.
But the upper end consumer is still looking for value. So you get a trade down like Shark Ninja competes with other firms like a Dyson, but at a little lower price point. The other thing we want is companies with product niches or innovation that can drive sales and that aren't relying on macro tailwinds. Because as I said, we're seeing some economic weakness. So you want companies that can drive growth through product innovation and not just relying on the macro environment.
You prefer small cap, mid cap space?
I like small cap. I mean, small caps are relatively inexpensive now.
Yeah.
They're also behaving differently over the past year. So on days when we've had some economic weakness, where small caps, normally you expect small caps to rally, I think second quarter of 2021. You're coming out of a bottom and rip-roaring economy. That's when you expect small caps to outperform. They've been doing well on days of economic weakness where rates come down. I think small caps are behaving much more rate sensitive than they used to.
Yeah.
So I think with the Fed cutting, and I think you're going to get a couple cuts this year, I think that could really benefit small caps. They're more leveraged than large caps, and they tend to borrow short.
David Royal, great to see you.
Great to see you.
Thanks for stopping by.
Thanks for having me.
Chief Financial and Investment Officer over at Thrivent.
Stay with us. More from Bloomberg Businessweek Daily coming up after this.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
It's our weekly Women, Money, and Power segment. We speak with some of the most influential women from across the business world. We welcome back Christina Lee, Managing Director and Co-Portfolio Manager for U.S. Private Debt Strategy at Oaktree Capital Management. She joins us here in the studio. Happy New Year. How are you?
Thank you. Well, thank you so much for having me back on. I think 2026 is a new year, and I think, as you can tell from the public markets, there's enthusiasm. I think from the private side, there's enthusiasm as well.
What's the enthusiasm that you're seeing?
I think it's about M&A demand. 2024. So when we were sitting back in 2024, thinking about 2025, everyone said with the new administration coming in, M&A is going to have a boom year in 2025. That didn't really happen, right? The first 9 months, M&A stalled, predominantly because there was so much uncertainty, for example, around tariffs, et cetera. But now I think where we're seeing that enthusiasm is, especially on the private equity side, is private equity has held on to their investments for too long now. They need exits. They need to provide distributions back to the limited partners. So we are seeing a backlog of deals to hit for 2026, which should help.
But are they good deals? If the backlog is that they need to return money to clients, they need to exit, like having to, force sales is never a good thing.
I think from a credit perspective, they're good deals.
Okay.
And why I say that is I think there has been a bit of a mismatch between buyers and sellers in terms of price. What we've seen is those that will sell for 12 times, 15 times, 18 times sell. Doesn't necessarily mean a business that's going to sell for 10 to 11 times is a bad business from a credit perspective. And that's why I think for private credit, seeing that increased demand should be a benefit to the industry. Because in Q4, what we saw was heightened competition because there was this supply-demand imbalance. A lot more private debt, dry powder versus M&A deals. Even if you looked at public markets in 2025, the majority of the volume was actually repricings and refinancings. There's very little new issues last year. So this is our year.
So of new issues.
Exactly.
Big deal. So how much dry powder, though, is out there? Like how much needs to be worked off still?
Yeah, if you were to look at dry powder in private credit versus private equity, everyone's like, wow, there's so much dry powder in private credit. There's still a lot in private equity, too. There's multiples. And so that's why we think, one, not only is there dry powder for private equity, a lot of that dry powder is aging. They need to deploy it. These are closed-end funds. They have a certain set investment period.
Right.
So they're going to be also looking to more deploy as well. And there's going to be more companies out there for them to buy.
Is there a specific type of company that you're seeing that's going to be doing this out there?
Yeah, I think what we've seen so far is thematically those that can only get very high purchase price multiples. And what do I mean by that? For example,
so it's not necessarily a certain industry?
It's not a certain industry. I think certain industries have benefited, for example, from very high public valuations. For example, everyone talks about AI. Everyone talks about data center. We saw a good number of deals come out in the market for M&A last year around data centers, around AI, because they were going for such expansive multiples. We saw less what I call kind of nuts and bolts industrial businesses. They're not bad businesses. They're just not going to go for 15, 18 times. So I think people reserved and held on to their deals, maybe to do some add-ons, build some growth in to then sell it for this year.
So how much of the activity that you think will go on is the result of just pent up, couldn't do anything for so long, versus wait, it's a good environment. It's indicative of a good business environment, deal environment, economic environment.
I think it's a combination. It's probably 50-50. And the reason I say that is, if you think about it, have we had a normal year in terms of M&A?
What is normal?
Normal year,
Well,
right?
Wasn't 2025, was it?
Wasn't 2025. It really wasn't 24. In normal year, I mean like a steady pace where expectations were met. Really hasn't. In a couple of years, we had supply chain issues, right?
I think we're just done with normal.
Right?
Yeah.
Post 2020, that's it.
I mean, normal is done in general, right?
Yeah, totally.
You know, so we haven't had quote unquote that normal M&A year. And so if you think about the pent up demand, it just wasn't 2025. It's been since 2020, really 2022, when there was a break in the public markets. Remember, first half of 2022, you saw the public markets break, even the private markets started to break.
Right.
So it's been multiple years. And I think that's having this pent up demand grow. And then second, we have a falling rate environment. It's better to get debt capital, right? That's beneficial for these companies. And the economy, granted, there's cracks in it, but it's still holding up.
So what if that doesn't continue, though? I think that's one of the big questions. I mean, we're seeing investors a little bit enthusiastic as we await a bunch of economic data this week and hopefully for some more clues about what the Fed's going to do this year. But I feel like people keep pulling back their expectations about Fed easings because there are inflationary concerns. If we don't get a lot more in the way of rate cuts, I mean, what do we need to do to kind of keep the market as you describe it now?
Yeah, I think...
Or the level of activity. Yeah.
I think the economy has to hold up. I think one of the things that will spook investors and I think will spook the M&A market is any type of downturn. We haven't had a real downturn since 2009.
It's kind of amazing.
Right? COVID was too short. There's this massive bounce back after
But there was
COVID.
a lot of people got scared then.
Yeah.
A lot of people in the markets got scared. A lot of people sold. But that didn't count in your view.
I don't think that counted because I think what was happening in 2020 was COVID was quote unquote short-lived. I think you saw kind of March through September really M&A dry up. But then as things started to normalize and there was so much dry powder again to support that M&A market, 2021 was like a banner year. Back half of 2020, 2021's banner year for M&A and private credit.
What's the relationship between your world and equity market performance?
Yeah, I think part of it is on the valuation side, right? And spurring M&A. The better the equity markets are doing, that supports higher purchase price multiples for the private markets as well, which spurs, therefore, M&A deal flow, which helps us because that's a big driver of demand. When there's not enough deals in the market, what happens with private credit is you have a lot more competition. What does that mean? Decrease spreads, increase leverage.
Yeah, you need to see like it all kind of flow through here. Your new fund that you guys launched in October, the Oaktree Direct Lending Evergreen Fund, institutional clients completed your first close with about $2.35 billion in committed capital. How much of that has been lent out, deployed at this point?
Yeah, I think just thinking about that product in general, when you think about an evergreen fund, it's kind of a newer product in direct lending, and you're raising money every quarter. It's an open-end fund. And so from a deployment standpoint, right, you're always going to be looking to deploy. And one of the things that we found is a growth factor in private credit are these newer types of vehicles. If you think about direct lending, it has been always kind of closed-end funds.
Yeah.
I think LPs are asking for evergreen funds. They want some place to get income, to be diversified, and a safe pair of hands and consistently deployed. And that's what Evergreen and frankly Oaktree provides.
Well, good stuff. Like, we were so looking forward to catching up with you. Happy New Year. Good to see you again.
Happy New Year as well. Thanks for having me.
We'll see you soon. Christina Lee, Managing Director, Co-Portfolio Manager for U.S. Private Debt over at Oaktree Capital.
This is the Bloomberg Businessweek Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.